Good afternoon, ladies and gentlemen. Happy Friday, October 27th, 2017 to you all. It is great to see you all here for our standard Friday open forum Q&A session. I hope you all had a good trading week with as interesting as how things were in the markets in the past few days. And of course, I'm sure you brought some of your questions with you. We've already got some questions coming in right off the bat on managing spreads and managing positions. I answered about 4 or 5 emails today and phone calls regarding managing of spreads, bearish spreads, in addition to Iron Condors and others. Well, before we begin, as always, I just want to discuss what is Power Options. Well, Power Options is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance. We do support over 23 of the commonly used option strategies. Once you've identified the position using a variety of stock, fundamental, technical, and option data for every strategy, you can then further research, analyze, and then use our portfolio tools to track, manage, and evaluate rollout opportunities for your positions as well. In addition to that, we do offer countless help videos to help you get more familiar with the tools on the site, a variety of blog articles and regular white papers on various option strategies and techniques, and a series, virtual library, I should say, of archived webinars that illustrate both the tools on the site, but also the various strategies, how to enter the strategies, how to use the tools for the strategies, and various management techniques. Ernie Zarrenter created Power Options back in 1997, but everyone here on staff, myself included, uses these tools to trade their personal accounts, so we have many more years of combined trading experience. Now, for our Friday discussions, our process and procedure for these afternoon presentations is when you logged on to the webinar, the GoToMeeting, GoToWebinar platform would have appeared on your screen. Inside that platform is a question pod. Simply use that question pod to pose a question at any time during the presentation. Now, we're scheduled to be here from 4:30 p.m. to 5:30 p.m. Eastern Time. However, if I do have a high volume of questions that have come in, I'll be more than happy to stay on till maybe 6 o'clock or a little bit after to make sure every question is handled. Now, your questions can really be about anything related to options and options investing. If you have questions about the general options strategy, how should I structure a covered call? What do I look for call buying or put buying? What is the structure or the correct strike prices to select for a credit spread or a debit spread? That's all fair game. Many of you might have questions about trade management. Is it okay to roll down a covered call if the stock is going against me? What should I do to manage an Iron Condor credit spread? That's actually going to be our first question today that already came in. You may have questions, of course, about just adjusting long calls that are moving against you or calendar spreads, anything you can think of. You may have questions about options specifics or even the options basics. What is a good implied volatility range to look for example? Or you may just have a question of how should I use delta to analyze the position? What is gamma? What is theta? Those are all questions that, of course, we'll be more than happy to field today. Of course, some of you may have questions about using the tools on Power Options for refining your searches or evaluating your positions using the portfolio tools. And some of you may have questions about the concepts of the radioactive trading techniques, the limited risk married put approach with the 12 different adjustments that are made off of those. So anything you can think of, send it my way. We'll be more than happy to address those in today's presentation. Basic ground rules. Don't be shy. Please feel free to ask any questions that you want at any time during the webinar. Now, be patient. There might be 1 or 2 questions ahead of yours, but as I mentioned, we will get through them all. I also want to encourage you to feel free to help us help others. A question comes in and I give a response based on my market experience, conversations I've had with other Power Options customers and options investors, or what I've done in my personal account. But you have a different way of looking at something, whether it's a trade management or entering a trade or a technical or fundamental indicator you look for in a strategy. I encourage you to send that to us during the discussion in the question pod, and I'll be more than happy to share that with the rest of the audience as well. Most important, let's have fun. We had some fun times this week with a little dip Monday, nothing really noticeable. Back up Tuesday. a little worry in the early morning Wednesday with the indexes down about 1.4, 1.3% near the open, or just about a half hour, 45 minutes afterwards. Then it got some of it back. Thursday was a little bit more back, and then today was a nice pop-up led by the tech sector, of course, positive earnings in different sectors as well. And that's where we might start at the beginning. Most important, let's have fun. Get some good education. Get ready for the long weekend, or not really the long weekend, but get ready for the weekend, and let's begin. All right, now I'm going to navigate over to the Power Options suite of tools. We're going to use these tools, of course, to illustrate our ideas and the questions that come in, visual discussion as well. So let me just change over our screen. Fantastic. What we're looking at here now is the basic 14-day free trial view of Power Options. And of course, those of you just getting started, I encourage you to take advantage of the 4 steps that are outlined here and grab that free quick start guide, go through the flash tutorials. We host a variety of live webinars during the week, and of course there's also several archived webinars you can access at any time. I am sure I'll reference that later in the presentation. And those of you that are trial members and subscribers to Power Options, you can schedule one of those coaching sessions at any time. Those are essentially a 40 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. Now, of course, if you're not a member of Power Options, we're always by the phone, so you can call us during market hours as well. Okay, sorry about that, folks. Just had to take a quick drink there. Now, our first question comes in today is from Kent. And Kent wants to know, can you please discuss means you use to get out of losing spreads or losing iron condors? Absolutely. Now, before we do anything, I'm going to reference something very quickly. If you go to our free webinars page at any time, here's the link right here, powerop.com/webinars.asp. I'm going to send that to everyone in the chat window. This is a public page. Don't even need to be a Power Options subscriber to access it. But when you go to the webinar archive, you see the different categories for our Power Options tools, option strategies, concepts, and the requested topics. It's usually where our Friday sessions are archived. Under option strategies, there are full webinars on, oh, I'm sorry, folks, managing your spread positions, our preferred 7 ways to manage credit or debit spreads. Further down, you'll also see individual ones on managing your bear call credit spreads, as well as other strategies, managing your naked puts, long option positions, vertical spreads also. So there's a variety of different ones there. It is managing your bear call credit spread. So you can access a variety of different webinars. But let's take a look at what I do, 7 ways I might look for to manage a spread position that goes against me. And we're going to take the bearish side because we saw a large movement today. I'm going to focus on ATVI. It has earnings coming up in about 3 or 4 days, I believe, or maybe it's 6 days. And the stock's currently at 64.16. But this ATVI, we'll take a look real quick at the stock chart. Let me just go back to a 2-month chart. I'm familiar with the stock. It's a RadioActive Trade that I'm in, actually. And as you can see, I mean, it was up here back in September in the $65, $66 range, and it pulled back. And over the last, 30 days or so, 40 days, it's really been in this $62 to $61 range, especially the last almost 30 days here after that recent dip down. But it was in the 62, 63 range, then it held here, and then all of a sudden today, it's up. So let's say I took this earlier this week. Seeing how the past almost 21 days, the stock's been trading, it hit 63 once or twice, but it didn't really move above that. It never closed above it. And it was borderline, never going below 61. So let's say earlier in the week, I had set up a spread. It's a little volatile in the last week, but let's say Monday, at close of Monday, or near to it, I set up a spread where I'm going to sell the 61 put and buy a 59. And at the same time, we're going to sell a 63 call and buy a 65. Okay? Excuse me. So before we do anything, I'm going to go back to Power Options. Let me clear out these drawings. And let's go to ATVI, and I need to go to the option chain very quickly. When you're on the trial, of course, one of our services that we offer, our subscriptions, is the historical service where you can access our historical data back to April of 2006, excuse me. But I'm just going to go back into October for our chain, and I'm going to go back to Monday, the 23rd. I'm just going to grab the closing prices for our 4 options that we're considering for calls and the puts. All right, so on Monday, October 23rd, ATVI was trading at 61.46. Some of you were taking a chance with the 61 put, but we're going to do it anyway. So I'm going to sell the 61 put, bid of 44, ask of 49. All right, so we're going to put in that we went ahead and we sold this for about 46 cents. Okay, not a great midpoint, but we're going to call that a 46-cent position. We're going to buy the 59 put for 10 cents. Okay, so we're going to get 36 cents on the bull put side. On the bear call, I'm selling the 63, not as good premium. We're going to go ahead and call that, of course, 15 cents. And at the same time, we're going to buy that 65 put, 65 call there, and we'll call it 2 cents. Okay, so we're getting an additional 13 cents for the bear call side on this ATVI spread for today's expiration, okay? All right. All right, now let's take a look here. Let's go ahead and build that in our custom spread builder, our profit and loss chart, and see where we stand. Well, we know where we stand, but what would we have done? So let me click on custom spreads, and we're going to put in our Iron Condor from Monday. I'm going to just use today's. Here we go. We're going to sell the 61 put, buy the 59. And at the same time, we're going to sell the 63 call, buy the 65. Let's put in our prices for Monday. Okay, so we'll just do one contract to keep the math simple. Here we go. 46 cents. We bought the 59 for 10 cents. Okay, all right. And then, of course, we sold the 63 call for 15. Not the best premium, and it did go against us. And we'd buy this for, excuse me, 2 cents. All right, let's take a look at our Iron Condor. All right, so here was our Iron Condor, 49-cent net credit off of a risk of 151 because we used 2-point spreads. Okay, so we're looking at about a 32% return if the stock stayed above our short put strike price of 61 and at the same time below, our call strike price, sold call strike price of 63. So we've got a bear call credit with a bull put credit. Now, at the beginning of today, what we would have seen, of course, is this was still down $2. It was around $62 at the close of yesterday. We still had a profitable spread. Now the position is gapped up against us, and we are at expiration. So, before we talk about the ways to manage a losing spread, the first thing I want to talk about, of course, is when would I look to move the spread? Okay. Well, as a general rule, what I look for, whether this was just a bear call spread by itself or part of an Iron Condor, I typically look to adjust or manage the losing side. If the stock reaches within maybe 1% or in a weekly series maybe 0.5% of my short option strike price, okay? So with the 61 strike sold, the 63 call, remember, that we sold, if the stock reached up to, let's say, 55.40 or so, within 1%, let's try that again. How about 62.40? I would have looked to manage the position. Also, if I'm doing an Iron Condor, I probably would have used a Bollinger Band range to make sure the stock was within 40 to 60%, was in the middle of the Bollinger Band range, or some kind of other channeling indicator that it wasn't trading up near the top or down near the bottom necessarily. Okay, But I would have done that, and if I've seen the Bollinger Band range change, or if I was just in a bear spread, I would have looked for a stock that was below its 20-day or 50-day moving average. Okay? And if that trend changed, and the stock was now trading above the 20-day moving average or reverse, then I would look to manage the position. Okay, well now the trigger's been hit. And this is one of those cases where I couldn't have done anything. It wasn't quite at, it was only at 62. It wasn't really at my trigger point the day before expiration, and then today it just snaps up in price and I'm looking at a losing trade. All right, so right at expiration, the day of expiration, a position goes against me. What are my options to manage a losing spread? It's our bear call side that's losing, but it's also a losing Iron Condor. Okay, but I'd manage them the same way. The side that's threatened of the Iron Condor or the trade itself. Number one, I could close the position, take the loss, and just move on. I wouldn't have opened this position unless I was comfortable taking the full loss. No one wants to take the full loss on the trade. But when you set up the position, you have to be comfortable and properly position size to where you can sustain that loss and still have a reasonable, not be a reasonable dent in your portfolio. Okay? So we could just close and move on. What would our loss be? Well, I'd have to close this position for about $1.16 to $1.20. My 63 call is $1.16 in the money. Let's just say I paid $1.20 to close it. I keep the 49 cents, so we have a loss of 71 cents on the position, okay, per contract. So maybe I just, in this case, so close to expiration, on expiration, I just close it and move on. Number two, I could close the position, of course, and roll the entire spread. Okay, so I'm going to let the bull put side expire. That's fine. I close my Iron Condor here on ATVI, and I take a 71 cent loss. Okay, now what I may look for, if my strategy is Iron Condors, and I solely stick with Iron Condors without paying attention to market movement or sentiment on a stock, I'm going to open a new Iron Condor. I'm going to try to look for next week's expiration. November 2nd or 3rd. Okay, November 2nd. But I need to get at least 71 cents. We saw a 1 week Iron Condor here at only 49 cents. So I might have to go out to that next expiration. I might have to go 2 weeks or even 3 weeks out in time to make a reasonable profit on an Iron Condor that's greater than 71 cents. Someone just made a comment. I'm going to address that in a moment too. Okay, there's a couple comments that came in regarding this. But we need to make up 71 cents, whether with an Iron Condor or another vertical spread. Okay, so if I close this and just roll the spread, I'm going to move this up with a stock at 64. I might be doing, let's say, a 66 to a 68 with maybe a 62 to 60, or maybe even keep the same 63, 61 on this side, depending on my expectation. Okay, we'll take a look at that in a moment. Number three, if I was just in a bear call spread, I might not consider number two. Why? Because if I adjust the bear call spread and the stock move against me, I was wrong on the sentiment. Sure, it just jumped up on the last 2 days, but there's a reason it jumped up, whether it was market as a whole, tech being strong. Sam's got some comments on trades that he made earlier this week that he emailed me. Sam also said he's looking for a pullback on Monday, perhaps. So that might be a good opportunity to just close the bear call and roll the position out. So what would I do there? Again, I'd let the bull put expire. I'd have to close my 63 and my 65 perhaps. Maybe I should leave the 65 open. But then I'd open a new bear call spread at maybe 65 to 67, more likely 66 to 68. But that new net credit has to be higher than the loss I've taken. It again would have to be higher than 71 cents. I'm probably going 2 weeks out or 3 weeks out from this 1 weekly Iron Condor because I'm not going to get 71 cents on a bear call spread for the next 2 or 3 days. Okay, so the third way is close. You know, if you're just in a vertical spread, Kent, you could just close and roll the spread up or down. Depending if it's a bear call, you'd roll them up. If it's a bull put and it moved against you, you'd roll the strikes down. Okay. Number 4, and this is for an Iron Condor, of course, but it could also work the other ways. Close and do the opposite. Okay, so you're going to have to close it anyway to avoid taking assignment on our 63 strike. So I have to close that as a minimum, but if I can get any value out of this 65, I might try to sell to close that too. So if I was in just the bear call here, Ken, and the stock moved against me, it's moving up. I was wrong on the sentiment. So instead of closing and just rolling to a new bear call spread, where I might have to roll it again in the next week, 2 weeks, or 3 weeks if the stock continues this trend, close and do the opposite. Okay, so I might close and do, might close my bear call, but now open a bull put. Again, 63.61, 62.60, somewhere along those lines. I'm not a fan of just closing a vertical spread and rolling the strikes out, because if I'm doing that, it means I was wrong on the sentiment and I could be wrong again. Okay? Okay, let me see here. A comment came in from Rajiv. He says, why anyone create an Iron Condor for weekly expiry? It should be best to close 10 days before. Okay, this is just an example, Rajiv. This is not the position that, I'm sorry, this is not the position that Kent was in. This is an example, I know, for a stock that suddenly gapped up today and how I would look to manage it. Okay, so we're looking at the theory of the idea, not the theory of an Iron Condor itself or the structure. We're just looking at the management after the fact. I chose a weekly spread, but hey, you know, you had mentioned there's not enough time value in 7 days. Yes, this spread is a loser. Oh, shoot. Sorry, folks. Hold on one second. There we go. This spread is a loser, but remember, it was a 32.5% potential return, a 49-cent credit off of a 2-point risk for an Iron Condor. That's not a bad weekly trade at all. If it had worked. If it had worked, but of course it didn't work. Okay, so this was a 32.5% return. All right, so I might close and do the opposite because it moved against me. And again, remember what I said earlier, if you want to stay in an Iron Condor, you've got to roll out in time. Now, Rajiv, I would normally do a 2-week out or 3-week out vertical spread or Iron Condor. You've heard me mention that before. And so if this one went against me today, if I had opened it for November 13th or standard November expiration, now it's against me. Well, one of the things I might do in this scenario is do that pendulum adjustment. I may just roll this call down to a lower strike to have 2 bullish spreads if the stock continues to move in that direction. All right, we'll talk about that in a moment too. Just looking at the bear call, it was very low cost, but the bear call on ATVI to see how we might fix that. Okay, so now close and do the opposite. Remember, that only works if you're in a vertical spread. The pendulum adjustment is another thing we can do. I am not a fan. So some of the other ones, you know, I showed you the 7 ways that we might manage it. Most of these, the pendulum adjustment and the other 2 ways I'd look to manage this position, only work if I still have, as Rajiv mentioned, 5 to 10 days left to expiration. If I'm on expiration day and it suddenly moved against me, I'm just considering these 4. The pendulum adjustment is out. Okay, so we're on expiration day. It moved against us. What can we do? Well, we already talked about what's going to happen. This is going to be closed for a cost of, we're going with $1.20. So our profit, is going to be, you know, we're going to close it for $1.20. But we took in 49 cents initially, right? So that leaves us with a debit of 71 cents. All right. Now I could go to the search by symbol tool very quickly. I'm just going to do it on the fly. But I know I'm 71 cents underwater. So I go to ATVI. We go to the November 3rd expiration. Let's see, if I did the 63 put at 134 and the 61 put at 73, all right, we're getting about 60 cents. And then if I did the 66 call at 105 and the 68 call at 50, we get another 50 cents. So this would actually be enough premium to repair the Iron Condor. Who's going to call me out on it first? I already mentioned it. I want to see who's paying attention. Someone's going to call me out on that first. I'm going to do the 66 and the 68. I might even want to give myself more breath to the 67, 69 since the stock is moving up in that direction. Let's take our look at our new Iron Condor. We closed our Condor out. We took a 71-cent loss. All right. We're going to get back in by selling the 63 and buying the 61 with a stock at 64, selling the 66 call, buying the 68, the new Iron Condor. Now this looks good. There's a $1.17 net credit. Let me just take something off of this real quick. Remember, I've got to take off 71 cents somewhere. Okay, so I'm just going to take the 71 cents. It's going to look strange, but I'm going to take the 71 cents off of here. So we're only going to sell the 63 put for 66 cents. Okay, that's taking into account the 71 cent loss I took on the other position. Okay. All right. Now, still a profit of 46 cents, close to the max profit I saw before. As long as the stock stays below 66 or moves above, stays above 63 and below 66 in the next 7 days. But something was curious there, wasn't it? Rajiv just pointed it out. Why were the 7-day out positions similar distance away from the stock this Monday only worth a net credit of 49 cents? Well, without factoring in our loss, we're looking at a net credit of almost $1 for next week's expiration. As I mentioned, it's because earnings are coming out on ATVI next week. What does that mean? That means if this was a real position, if this was my real Iron Condor that jumped up against me today and caused me to have this loss, I'm not rolling to a bear call, a bull put, or an Iron Condor for next week at all, because I'm going to play something that would have a different view. In other words, a short straddle, where with the earnings movement, if it moves one direction or the other, I can try to make a profit if the move is big enough. Or a long strangle, using an out-of-the-money call and out-of-the-money put. And Rajiv mentioned a reverse Iron Condor, which is similar to the long strangle, but of course it does something more along the lines of this, where here's your profit line, here's your loss in the middle, but you're selling some options out here to give you sort of a limited profit up or down. It is, you could do this, Rajiv, around earnings, the reverse Iron Condor in this scenario, but I'd prefer maybe to do a long strangle because this ends up with a capped gain if there's a really significant movement. And we saw some big ones today. The Iron Condor I helped a customer with earlier today was on First Solar. Now the customer didn't pay attention to the earnings, of course, and FSLR was up about 20%. I believe the customer had the, was it 55, 57 and a half bear call side of his Iron Condor, and it blew up to about 57.80 today, $58. So he's got a full loss in his Iron Condor position, and not to leave the short call open. Okay, but that's one you could do. Just roll the whole Iron Condor out. Just make sure it doesn't have an event coming up next week. Okay, we talked about now that the stock has moved up. Again, I know this might not be the best example, but now the stock has moved up. I might not want to be in an Iron Condor if I think the sentiment has changed. We saw the profit and loss chart and how we could sort of define a support and resistance level over the last 15 to 20 days from October 6th on. And we set up a Condor that looked like it wasn't going to breach those two values, the original Condor, not this new one we just built. But today threw us for a loop. It gapped up 2 points, went above $63 where it hasn't been for 25 days, so we were blown through there, and now we have to manage it, okay? So that's something to consider. You could roll the whole Iron Condor out. In this case, though, it had moved against me, and if my sentiment has changed, remember we had a 71-cent debit. Well, I could open a 1 week out bull put and get 60 back in this case, but I'd probably have to go 2 to 3 weeks out. But again, of course, I'm not doing it on this stock because it has the earnings there as well. Okay. Rajiv says a similar thing happened to him today. What we're seeing with the fake ATVI position with a butterfly on Microsoft. Yes, good strong movements today in the tech. All right. So I could just convert it to a vertical spread in one direction or the other. In this case, when I'm at the break. Now, I'm going to take a bear call. I'm going to go out to November 3rd, and we're going to take the 63, 65. Okay, and we're going to sell them at different prices. And let's say my original 63.65 for last week was very cheap. This one would have been overpriced because it was going to be affected by earnings. But let's say this was my position. A 50-cent net credit. This is very high, probably too high. Let's take that down. Let's put this at 60. Okay, that's good. All right. All right, so a 35-cent net credit on a bear call spread. There still is 7 days to go to expiration. I still have time, and out of nowhere, the stock breached my short call strike price on my bear call. I need it to stay below 63. Now, what could we talk about? We talked about how we could close the position and do the opposite. I could close out my 63 and my 65 and then sell maybe a 65, 67 for the next following week. I'm going to lower the max return, but I still might be able to get a positive net credit by just moving it up. We could close it and do the opposite. I might close this and just do the bull put credit spread, 63, 61, for example, and so forth. The other adjustment I mentioned, the pendulum adjustment, now that my sentiment has changed, of course, what I'm thinking about is I want to convert this bearish position to a bullish spread. But I might not want to change expiration dates. I don't want to change the whole spread. So you can easily convert a bear credit or a bear debit, or a bull credit or a bull debit, to the opposite position with one move. I can sell to close my 65 call and maybe buy to open a 61. I leave the 63 short alone. So we call this a pendulum adjustment because I'm swinging this way, and I've immediately converted my bear call credit into a bull call debit on a stock that now has a massive bullish trend that I thought was neutral to bearish, but it moved against me. Okay, so what would that look like? Well, it works if the new cost for the debit position happens to be less than, so the new debit has to be less than the difference in strike prices plus the original net credit. If I'm able to do that, if the debit from performing this role is less than the 2-point difference in strike prices plus the net credit, this will be a profitable adjustment. Let's simulate it and see if it works. I don't know if it works. It doesn't work every time. But when my stock goes between the strike prices, suddenly I look to perform the pendulum adjustment on my vertical spread first to see if that can get me out of trouble and convert my bearish to a bull. What I need to do is sell to close my long 65 call. We're just going to put it at $1.45. All right, so we're just going to sell to close for $1.45. Now here comes the pain. I have to buy the 61 call. I'm just keeping a 2-strike difference. Looks like it's going to be about $3.90. So this is not going to cut it. I'm going to be about 10 cents short, I think. So what is it going to cost me to roll the position? It's going to cost me $2.45. We originally only collected 35 cents of net credit, and I've got a 2-point strike difference. So we're going to be 10 cents short. But I did move a bear call credit to now a bull call debit, and if I'd received a little bit more premium up front, or if this debit wasn't too large here between the roll, this would be a profitable position, maybe only 15 or 20 cents, where my short option, like the bull put, probably now has a 68, 73% chance of the stock now remaining above that position. Okay, so that's the pendulum adjustment. Didn't work in this case, but it does work in several cases if the stock moves between your strike prices and you still have time to expiration. But again, if you're right at expiration and the stock goes through both strike prices, let's go back and take a look at, let me see if I can go back a couple here. I want to take a look at our original Condor. Just bear with me one second. Is that it? No, that's the managed Condor. Let me go back one more. I apologize. Perfect. Okay. Since this was right at expiration, my choices are limited. I am going to let the bull put now expire worthless today, and I've got to close this bear call. We already showed that that would take a 71-cent loss. So now, Kent, anytime you have to close a position or manage a spread, before you think about just managing the spread you're in by rolling the spread out to higher strikes. If you're in a bear call, you move it up and out in time. Or if you're in a bull put, you move the strikes down and out in time. Okay? If you're in an Iron Condor, you're going to try to move the Condors, well, terrible drawing. You're going to move the Condors to the new Condor, the stock's trading between the strike prices. Okay? But before you even do that, what I'm showing you is ideas you can have in your toolbox to manage these spreads when they start to go against you. But just like anything else, before you make an adjustment, you have to reevaluate the stock as a whole. Before you even consider option 1, option 2, option 3, or option 4, or option 5 of how you might manage a spread, reevaluate the entire stock. What was the reason for the jump today? Was it just because it was moved along with the rest of the market? Was it just because of the strength in tech that buoyed it up? Was there other news on ATVI? Almost look at it again as a brand new stock, not even considering the loss you took on the position. Because that's going to determine if you think the stock's going to continue up, you don't want to be in an Iron Condor. Sam had mentioned to me in email that he thinks Monday there's going to be a pullback. If I think it's going to pull back on Monday back to 63 or 62.50, I don't want to roll to an Iron Condor now. I'm going to wait to see what happens on Monday and Tuesday and then maybe reevaluate the position. Okay, I don't want to panic adjust in this scenario. That's bad news. Okay, so you have to reevaluate the stock before doing any adjustments as well. All right, and in addition to that, excuse me, there is another technique I could use, and Sam mentioned this. Sam brought this up, and this was one of the 6 or 7, 0.6 or 0.7. I said I wasn't going to show because it's right at expiration. But in that other case where I still had time remaining on the spread, this one we don't. If I think the stock has now gone bullish, I may just buy to close the 63 call for a large loss and leave the long call open. So now if the stock continues up, I might be able to gain more on this long call than the cost to close the short and still have a profit. Sam says you could buy more calls. I'd prefer in an Iron Condor that moved against me that I still have time left is to simply buy to close the short, leave the long open if my sentiment has changed and it's bullish. And if, of course, the stock fell, might buy to close the short put, leave the long put open. But to the point Rajiv mentioned earlier, I can't do that at expiration. I can't do that mainly even with a weekly Iron Condor. This would have to be 15 to 20 days remaining to expiration for me to consider buying to close the short and leaving the long open, okay, as well. Now there's a whole bunch of other things you can do, all right? Some comments came in as, okay, well you took the loss on this, well you could buy another stock to hedge the loss. Why complicate it? Manage this position. Close out what's losing you money, which is the short call in this scenario. Get rid of that. Close it now before larger losses. If I was in the November 3rd series, is it possible that ATVI could come back to $62.50 or $62? Of course it could. But what's hitting me now, what's hurting me now the most is this short call. I've got to consider what to do with that, what to adjust with that if I want to adjust the whole spread or move on. For vertical spreads also, just a bull put or a bear call. Some people like to consider managing it by creating a broken wing butterfly. I don't like to overcomplicate it. If you're comfortable with condors and spreads, stay with condors and spreads. If that's what you know, don't try to overcomplicate it by adding 2 or 3 extra legs to an already 2 or 3, 4 leg open position for a repair. Okay? Just get rid of what's losing you money, reevaluate the position, see where you stand. Okay? And as I mentioned, of course, if we go back, let me close out that. You go back here to free webinars. Managing your spread positions is a full presentation on managing credit and debit spreads. And honestly, it's the same thing I would do with Iron Condors. If the bear call side goes against me, okay, then I'm managing it just as I would a bear call. Not worried about the put side in the Iron Condor. I'm approaching it the same way. All right. So that's sort of my summary on the ways to consider managing a credit spread or an Iron Condor. There's many ways to do out there. You can convert it to a broken wing butterfly. You could add calls on this. You could convert it to a ratio butterfly position or just a ratio condor position. I'm not a fan of overly complicating it. I like to keep it simple first, close out what's losing me money now instead of adding additional option legs to create a 6 or 7 leg position where I still have 1 or 2 short calls that are in the money and I may have to deliver stock at any time. Okay. All right, David wants to talk about, he's sent in a question earlier as well. Let's see here, let me get back there. Sorry, David's talking about the radioactive trading techniques, the married put positions, where we typically start off every position as a stock and put combination. And then we use 12 different income methods. One of them is when I buy the stock and I buy the put, if the stock moves up in price, I can roll this put up. It's called income method number 4, okay? All right, so let me explain what this is. In relation to income method number 4, there's a specific rule. And I'm going to take ATVI again, just because we've been talking about it and I know what it is. And I'm going to go to the chain. We're going to go to Monday again, historically, for ATVI. I know where the stock was because we just looked it up. What I need is a specific put strike price. All right? On Monday, ATVI was trading at 61.46. I'll look at just puts. And I want to go out to April. I'll go out to February. No, I'm going to go out to May. I'm going to be realistic. If I opened a radioactive married put position on ATVI on Monday, I would have bought the stock at 61.46. I would have likely bought the 65, but we're going to go with the 62.50. And I'm going to call that at 6.05. Okay, 62.50 May at 6.05. All right. So let's go to our custom spreads again. We're going to clear all this out. So on Monday, I bought ATVI, keep it simple, 100 shares of stock at 61.46. Bought the May, would have bought the May. This is not my real position. I opened a different position this week. 62.5 put at 6.05. All right, so just hold on, everyone. All right, there we go. Now, here's my married put structure, right at the cusp of the maximum risk I like to take. I don't like to take a risk of greater than 7.5% for personal preference. In any case, here's my married put out about 200 days in time, was it? I apologize for that. I should have looked. 203. So we're 203 days out in time. I've got insurance out to May with earnings coming up, and the most I can lose in a catastrophic situation, even if the stock drops to 50, is 7.4%. Okay? But that's only at expiration. The curved red line here shows at the halfway point on February 7th, I'm not losing that full amount just quite yet. Okay, but now the stock gapped up today. It gapped up to 64.14. My put went from being slightly in the money when I opened the position to now out of the money. But it still has a lot of value. Okay, although the stock moved from 61.46 to 64.14, we're up about 260. My put, that May 62.5 put's probably priced, looks like 520. Okay? So here we go with this position. So the stock's trading at 5, or my call's at 5, my put's at 520. All right, so what does that tell me? I only lost 80 cents on the put. The stock moved up $2.46, roughly, from 61.46, I'm sorry, $2.60, okay? So I'm not giving up that much. This still has so much time value. I have a positive gain right now in the stock. I'm very positive because if I liquidated now, I'd get 69.34 back and only paid 67.51 in the position. So I'm going to sell to close this and buy to open the 65. And what am I looking for here? What the question really came out to be, let's put that 645, is when I do this adjustment, I sell to close the 62.50 and buy a higher strike put, I am paying a debit. I'm adding another $1.25 into the position to get a guaranteed $2.50 higher payout. So whenever I do this adjustment on the position, I want to make sure that the debit that I'm paying is less than 60% of the gain I'm getting in the puts. So here we're at 50%. I'm paying $125 to get a $2.50 higher payout. So it's almost like getting a $1.25 premium. Okay? So, fantastic. But that's what I look for. It has this ratio, the debit to strike difference ratio, has to be less than 60% for me to consider this. This one should cut my risk in half. Oh, it didn't really. But it drops the risk down to 5.5%. Okay? Now I could do other adjustments at this point to further lower that. But that's the first rule, is that the debit should be 60% or less of your gain in the difference in strike prices. But the real question is something different. Let's say I was in this position that I am. David's real question here is, let's say that I'm in the position here, which I am. I can't remember my exact cost basis now after all the adjustments I've made, but I'm going to call it 60.25. Holding the November 65 put. That's about right. Okay, so this is my current position on ATVI. It's a bulletproof married put position with earnings coming up, but I'm holding the 65 put. I have this rule I just showed where if I roll in the same month, I keep that ratio. What David really wants to know is if I decided I want to extend this trade now and I want to roll from the November 65 put out to the February or May, let's go February, because I'm coming too close to expiration, I want to extend the position. I got to sell the November first, don't I? Sorry about that. Let's get this right here. All right, so I got to sell this again, this 65. It's at 258. And then I need to buy the February same strike 65. It's going to be 510. All right? So what do you notice there? In this example, it's about the same, isn't it? Here I'm paying a debit of about 250. Oops, I'm sorry about that. But I'm not gaining any strikes. I'm keeping it the same because the stock hasn't moved up. Okay? So there's no ratio between the strike prices I look for in this situation, David, honestly. Okay, so if I'm increasing this 1, 2, or 3, or 4 months further out, I'm not worried about the ratio. I'm worried about this. How much risk does it increase? Okay? If I rolled from the November 65 put and I want to give myself more time, and I roll out to February, which is roughly 3 months away, 4 months away. It's really 3 months away from my existing expiration. Okay, so we'll call it 3 months away. I want to make sure that the max risk does not increase by probably more than 1 to 1.5% per month. Okay, so I don't want this to really go above 4.5%. In this case, it's okay. I've added another 116 days of insurance to my position to put my risk at 2.3%. Although, remember I was bulletproof 1.6%, so this is actually an increase of 3.9%, almost 4% for 3 months, under 1.5%. Rather than ask yourself, David, when you do this, is there a ratio I should be looking for when adjusting the put to increase the time? Focus more on the new risk on the position, and does that make sense for your trading goals? When you open a RadioActive Trade now, I know you follow the rules. You go out 5 or 6 months out in time with the put. You probably look for a risk between 4 to 8%. You've probably decided that, if I'm going 5 months out, I don't want to be more than 1.2, 1.3% risk per month. All right, so it's putting you around the 6% range. Use the same idea when you're rolling the put, trying to extend the time. Make sure that the new structure that you have, the new at risk of the new structure that you have, still falls in your risk per month tolerance that you use when opening a married put position, rather than focus on the ratio between the two, as you do with just a standard income method number 4. This is a little bit different trade, trying to increase it as well. So you want to look for that kind of scenario, okay? Sam had mentioned that one has to look at the, was it Sam? I'm sorry. Yeah, Sam mentioned one has to look at the wave pattern on a stock, see when you could buy the put when the RSI is at 60 or higher for the stock to tend to drop as well, okay? There's different technical analysis, but my assumption here, Sam, and I thank you for commenting on what you would use to analyze the wave patterns and so forth, and the RSI that you would use when buying a put or trying to roll a put. It's all good suggestions. I have nothing wrong with it. But I really want to be focused on this. For example, let me give you another one. And actually, I can just tell you what it is now. It's not my favorite position. It's kind of a losing trade that not a fan of, and I'm holding it just now to, it's still out to January. I'm in CFG, okay? And Sam, you had mentioned earlier that you were in the banking positions. You've got some good banks in there. I thought this was a really good trade a while back. It turned out to be a good trade, then it fell, and then it came back. But the CFG position here, let's see. Okay, there we go. Sorry about that. We on the same screen, make sure. Okay, this is the RadioActive Trading Fusion portfolio. Ernie's bulletproof on 4 out of his 5 positions. He had to mention that yesterday to rub it into my face. But I just opened a new position this week on AMAT. One recently on Planet Fitness, not too recently, but it's profitable already, as is this one. The CFG isn't the biggest loss, but my average cost basis on the stock now is about $37.75. Oh, $37.57. And let me write that down, $37.57. And I'm holding the 40 put, $4.89. Okay, so that's a January. So let's clear this out. There we go. And the January put 40 strike. I'm sorry, did I say 489 or 449? 489. And I will collect another dividend in the next couple of days. Okay. So here's the position. All of my costs for closing positions, rolling positions are included in that 37.57, and I'm holding the January 40 put at 489. I've got a 5.8% risk, and as you can see, I'm pretty much near 80 to 90% of it. The stock's at 38.45. Okay, but I'm getting closer to January expiration. Really not, but let's say I wanted to extend it almost twice as much. I want to roll it out to April with the stock at 38.45 to give myself more time. Holding a risk right now of 5.8%. Sell to close this at 260. Buy to open that at 355. So 260. And buy to open the April 40 put, same strike, at 355. Debit of 95 cents. Not bad at all. But how's that going to affect my risk? Takes it up to 7.9%. So to add an additional 80 days, 90 days in time, I increase the risk from 5.8 to 7.9 for an additional 3 months, or up 2.1%. So 0.7% risk added per month. I'm okay with that. Not saying I'm going to do this. I'm actually going to wait for a little bit closer. One might say, why aren't you selling the 40 call right now for November or December? It's because the premiums are terrible. It only offers 5-point strike differences in monthly options and get a barely 60 cents for the December. for my original position, which really doesn't help the risk too much. Right, it's 5.8%. It does, but you know, I'm looking for more. Okay, is what I'm looking for. I wouldn't mind selling the November for 50 cents right now, but it's only at 25, 30 cents. I might probably actually do that soon to get something off of this. But that's the key. Focus more on what is the new risk increase as opposed to what is the ratio between the new put option. Really focus on that risk first as well. All right, so let's see here. Let me go back up to our few more questions still in here. Okay. This is going to take a while for me to get through. Rajiv is asking a question about a calendar spread. All right, so we're looking at a calendar spread on Facebook. Sold November 3rd, 185. Oh. 185 call for 240. Oh, well, 5. All right, sorry. And bought the same November 10, 182 and a half for 278. Sorry, okay. Cost should be a debit of 39 cents per contract, 190 total. Here's your calendar call. Did I do calendar calls? I'm sorry. Yeah, there's your calendar call right now for the November 3rd expiration. All right. You're planning to close this position before earnings. 805 per position, hoping Vega will increase. How to manage if FB price will go down before earnings. What's hurting you when this is dropping down? It's not the 185 call you sold. That's decaying in price, working in your favor. So if before earnings, Facebook starts to move down, your risk is on what you paid to get into. It's this 182.50 call that's dropping. Okay, and the stock's at 177.80. So how would you manage a long call that's falling in price? Well, again, you may consider rolling the call down. Okay, why would I do that? Because if I roll the call down, sell to close this at a lower price, buy a 180 or a 177.50 at a lower strike, okay? That's going to change the dynamic of this, and it's going to be done at a debit. It says roll down the call, the long call, roll down the long, okay? That's going to be done at a debit, which is going to naturally increase your cost basis, and is probably going to lower this maximum return. But if it recovers afterwards and moves back up, you're going to have a larger percentage gain on the deeper in the money call at this point than you would by doing nothing and leaving the 182.50 open. Okay, so you could roll the call down, almost like we'd roll down the put in a radioactive trade with the expectation the stock would recover. If you think the stock's going to continue to move down, you just might want to get out of this position and open a calendar put spread. Okay, you could do a double diagonal against this. You could add a calendar put spread to it for the same expiration cycles to sort of give you that calendar, I'm sorry, it goes like this, calendar Iron Condor position. That's a terrible drawing. In that situation, something like that, sort of like a little volcano here, a caldera in the old ancient caldera, but you could do that too. So roll the long call down because that's what's losing money as the stock is moving against you. It's the long call, not the short. The short is gaining in your favor. Is it a wise idea to buy to close the short for a cheaper price and sell a lower strike? Well, how much lower can you go? If you sell a call now below your long call, you've converted this little bullish tent calendar spread into a bearish. Okay, that's not going to do it for you unless you think the stock's going to continue to move down. Just like I mentioned before rolling, reevaluate the position. It fell. It falls further. What do you expect is going to happen to go next? If after it falls again, your expectation is it's going to come back up, you don't want to, you don't want to be in that bearish position, do you? Because then you could lose on this, all right? So roll the long down if you're expecting it to move back up. If you're expecting it to stabilize After it moves down, you could add a calendar put to it to create a double diagonal. Selling a November 3rd, buying a November 10, at strikes you feel the stock would, be reasonable to stay below for the calendar put spread. So add a calendar put to create the double diagonal. 3, out of order, always an option. Close the spread if you have a profit right now. You're going to close it before earnings anyway. Close for the profit right now. Don't worry about over managing it. Reevaluate the position after earnings. Okay, that's another idea. In some situations, I would say that you can roll the call down here. You take a profit here, you can sell another premium here. It's going to change the upper strike, and you're really close. All right, so you could create a horizontal by rolling down to the 182.50. But again, if you're thinking the stock's going to move back up, a horizontal doesn't favor you because the new horizontal calendar call spread would give you sort of a tent profit and loss chart, which now is an upper and lower break even. So if the stock recovers before you close it, you could be losing on this side where you would have been up here on your original spread. Reevaluate the position. Make your adjustments based on where you think the stock's going to go next. Okay? So remember, stock starts moving against you now for your calendar. What's losing, whenever, in any spread, when a stock starts to move against you and you think about rolling a position or adjusting a position, Sam comments that Facebook is going to go higher into the earnings, and not necessarily in this earnings, but he says he has a history of dropping after good earnings, but he feels it's going to move higher into earnings. Can't comment on that, not going to speculate one way or the other. So in this scenario, depending on what your outlook is, I mean, if you're planning on closing it before earnings anyway, I might go ahead and close it early and take the profit now. Of course, we have to wait till Monday to see what happens. But in any spread, in any strategy, in a covered call position, even a cash secured naked put, but in a vertical debit, calendar debit, credit, if the stock's moving against you and you're thinking about an adjustment, ask yourself this question first. What is losing me the most money? And in a debit spread and a calendar spread, this gets tricky because what's losing you the most money as the stock falls is your long option. So the idea is, oh, well, I got to get rid of that because I'm making money on the short call. So let me go ahead and sell to close the long. Well, no. Now you're in a naked call. We don't want to be in that if the stock recovers or you're going into earnings. You got infinite risk to the upside. That's where the trap is. But when you're looking to evaluate a position, even in a covered call, remember, when you're in a covered call and the stock's falling, what's losing you the most value? It's the stock. It's not the short call. That's actually decaying in your favor. The stock's what's hurting you the most in this scenario. So you've got to reevaluate. And if you reevaluate a covered call where you think the stock's still going to go down after it's changed and it's moved a little bit bearish, if you think it's going to continue down, get out of the position. You could cover it with a collar, but in reality, get out of the position. If it continues down, you're going to lose much more in the stock than you ever can repair with short call. On a calendar spread, you are losing leverage. You've only got a 39-cent cost basis, so rolling down here could give you some extra value, but remember, you don't have much movement between these strikes. And if you rolled down and sold the 180 call for November 3rd, you bought back the 185 and sold the 180, you're now in a bearish position. And if the stock recovers, you could lose on that side. Let's look at it real quick. Right now, you've got the sold call at the higher strike. You've bought the lower strike call. You did it at a cost of 39 cents. Not that bad of a debit at all. Very respectable return if the stock does hit your price back up here at expiration. If you've already mentioned you plan on closing it before earnings altogether, not a problem. But let's take a look. Let's say I roll down now with a stock at 177. I want to take advantage of some of this gain I have on the 185 short call. November 3rd, my apologies. It's a 185 call. It's only at 165. And I'm going to sell a 180 for 335. This is going to look beautiful at first, but remember the obligation. So let's buy back 5 calls of the 185 and sell to open 5 of the 180s for November 3rd expiration, which is now below your 182.5 long. It looks pretty good. you've still got a max profit here of about $1,555. Still a reasonable profit if the stock moves down. The risk now is if the stock moves up. If it goes above 187.5, you're going to have a large loss to the upside, okay? Now, there is a limited maximum risk to the upside, but remember, you're no longer in a true calendar spread. You're in a bearish calendar spread where there's actually a monetary requirement. Why? Because you own the right to buy shares of stock at 182.50, and before, you had to obligate at 185. But it was at a lower strike price, so this was covering the 185. Now you have an obligation to deliver at 180. So anywhere between 180 and 182.5, if you're assigned, you've got to cover that margin requirement. So you got to add 250 to the margin requirement. You're doing this at a credit now. Look at that. Now you have a credit instead of the debit by doing this. It's at 167.50. Or 665, I'm sorry, 665 total net credit by rolling down. But you've got to put up the monetary requirement, so you have a risk of 1835. But because it's now essentially a bear call credit spread, the most you can lose is this amount, which comes out to be 565. Okay? And the max profit if the stock's at 180, 1,555. Almost the same monetary requirement or monetary max gain you had on the other position, but the return looks so much higher because it was off a cost basis of 39 cents. Okay? And Sam says if you did a bull put spread today, yeah, you would have made money. Well, yeah, that's true, of course, but this was an older position, a calendar position. So you could convert it to this, but you're going to have to put up the monetary requirement. But again, if your expectation is it's going to recover and start moving up, your return is going to be less if it goes back to that 183, 184, 185. But at 180, that's peak. It's $1,555 at November 3rd expiration. I'm not saying that this is a bad play, but it does change the dynamic. And now you have to cover because you're short the lower strike price instead of being short the higher strike price. You have to cover that margin requirement for the position. But you get a credit. It's kind of neat. Okay, so that's an adjustment you could use, but does it match your sentiment? Where's your risk now? Your risk is up here as you go further up in price. But it is capped, which is a good thing. All right, so Rajiv had another question. Rajiv wants to look at a married put on a stock that's lost 50% in value. I'm going to say okay, but why? if a stock fell 50% when I was in a married put, I'm out of the position. I'm closing it for my 5 or 6% loss. I'm not trying to manage that position any further. There's no way I'm doing that. Let's see here. Give me a stock. 50% loser. What was the one I had last? I studied last week. Studied last month. Big drop in earnings, fell. Sam says UVXY is a good example. I don't know if that's a great example because the premiums are too inflated and it's not something I'd ever use for a married put. But let's take a look here. UVXY. Let's see. You're absolutely right, Sam. It's dead in the water. Let me go 6 months. Perfect. All right, here. Let's say I entered UVXY on September 8th, September 5th, September 8th, okay? UVXY September 8th. All right, let's say I entered as a married put. Yep, 30 to 15, Sam, that's exactly where we're at. Good call. I like it. It'll be good for our example. Thank you. Just that this is not a position I would use for a married put position. Like you, I'd play this with calls and puts going back and forth, playing volatility, similar to... I apologize, VIX, VXX, things like that. Let me try September 8th. Let's see what we've got. Am I at that price? Yeah, 31.83. All right, we'll use this. 30 down, we're down to 15. So on September 8th, I buy UVXY, 100 shares, 31.83. I would have looked for my put 150 days out in time, so I'm likely into March. And, oh dear God. This is, you can see right now I'm saying that. Apologize if my phrasing offends anyone. take the Lord's name in vain here, but wow. Yeah. These are going to be 20% risks. So, all right, 35, let's keep the math simple. 35 strike, 1670, 1685. All right, 35 strike for March, 1685. I knew they were expensive. I didn't realize they were that expensive. Like I said, Sam, I don't do UVXY the same way. I don't go out 5 or 6 months either. I'm usually within 30 days for the VIX and the other positions. I wasn't ready for that. Sorry. Let's enter into our custom spread. Keep in mind, well, maybe I'll fudge the numbers just to show a reasonable married put, but let's just take a look at what this would have been. 31.83 on September 8th. Would have bought the March 35 put. One contract at 1685. All right, so here we go. 28.1%. Right now I'm pretty much at maximum loss on the position. Let's do this. We're going to fake this. It's still UVXY, but we're going to fake this a little bit. Okay? We're going to put in 850. Trying to get about, wow, my math is way off today. I apologize. So yeah, it's about 320. We'll put in 550. It's a normal risk I'd look for, about 6%, 6.2%. That's a normal married put. Now the stock's down 50%. Okay? All right. Now, am I going to manage this position? No. I'm not. If a married put goes against me 10, 15, 20, 35, 40, 50%, and it's near its low right now, oh, sorry, wrong one, and it's near its low right now, I'm not managing this position at all. I could try to roll this put down, but why? It would increase my risk by so much it's not worth it. What I want to do is go back to the chart, okay? And we'll go 3-month chart. There we go. It's about 30 there. There's our September 8th. And just by the way I do it, doesn't have to be the way you do it, but you should be using indicators, technical and fundamental indicators when you're analyzing a position. So I'm going to put in what I usually put in, what I show in the radioactive trading webinars, is the Bollinger Bands and the MACD. Now, I can tell you this right now, September, oh, let me scroll down a little bit. I know this isn't the perfect example, but I would not have entered this position on September, I might have, okay? It's very close. Here it is at 30. It's dropped down below the lower band. It's under the 20-day, and it looks like it's going to come back up. On a chart like this, I'm not doing it unless it's above the 20-day moving average and the MACD is crossed over at least 2 or 3 positive days. An RSI would like to be above here, but it doesn't have to be. This I would not enter. But let's say that I entered over here. Okay, right around the same time the stock was at 25, it gapped up, pulled back down, and then it started this. When I see this MACD cross over here, and if I haven't, when I saw it here, this is when I would have exited the position. Okay, so if I got in here at 25 and it moved up, I saw the confirmation crossover either there or there, and you know what? It would have been here because then it's below its 20-day moving average. This is when I would have exited the trade. Where I'm going with this, Rajiv, is that at this point, even if I had entered here, yes, I wouldn't have entered this position here, but at this point, I'm not looking to roll the position down, or maybe I am. I'll talk about that in a moment. I'm not looking to roll the position down when I see this crossover. I'm looking to exit it. Or, at this point, I create an income method number 12 and buy another put on my radioactive trade if I think it's going bearish, or sell to close my stock at this point at $30 when I originally got in here, let's say at 25, and now I'm selling to close it at 30 and leave the put open. When I see a bearish confirmation signal on a position, and yes, the volatilities are entirely different, but when I see that negative MACD cross with it dropping below its support and the 20-day moving average, and especially now it's starting to flirt with these lower Bollinger Bands, I'm definitely out at this point here at about 21 or 22. I'm not going to hold a married put that drops that much. If I haven't adjusted it in the first place, okay, if I haven't adjusted it in the first place on that first crossover line here, I'm definitely not holding it till it's a 50% drop and I'm already at 90% of my maximum risk. Usually when the stock falls 5 or 6%, that's when you'd want to look to do your first maybe income method number 9 adjustment. And if it continues to fall and you get a confirmed bearish thing, get out of it entirely. It's not worth it. It's not worth staying in to manage the position. As I mentioned, you could just sell the stock and leave the put open in this scenario. So as it continues down, you make the profit. And at the same time, I could enter another put if I think it's gone negative on me to get that synthetic strangle or straddle. Okay? And yeah, I hear you, Rajiv, when you said sometimes we get stuck with stocks like GE or so forth. And let's just take a look at GE. I know it hasn't dropped 50% in the last 3 months, but it has had a significant drop. Same 3-month chart. Actually, yeah, same 3-month chart. It's at about, we're flirting with 26, and now it's just below 21. Okay, so bought a put here. I would have stayed in through this, but when I saw it break below this lower band, it's very difficult because the crossover isn't clear, and then it did start to move back up. So if I got in over here, not too bad. The MACD, look here, starts to move up. It doesn't really do it, so I probably wouldn't have entered this. And at this point, though, it's not really a confirm. I mean, it dropped below the lower band, but it's not there yet. And it moves up and it moves up. So right about here, we're doing really good. We've got that peak. We're within just a percentage or two, and then we get the hiccup down. And at first, I probably wouldn't have closed here. I would have likely closed right here, below the band, and still not much of a confirm, but I definitely would have closed here. And even if I closed on this day with this negative crossover right at about 23.80, remember we got in at about 25.50. So that's only a $1.70 drop. That's significant. But I'm out here. I'm not holding for this decline. Okay? That's not what I'm going to do. I'm going to get out before then. I'm not saying I would have bought the extra put here to create the straddle. It does look like a good positive negative confirmation to me on both ends of that spectrum where it could have been done, or sell to close the stock and leave the put open. I mean, that's pretty positive negative signal. But again, I'm not holding it till it gets to that 50% drop. Okay, and something I'll show you with, I don't know if you were with us during this trade. I should have done it differently, but I didn't. I'm going to go to the track record for my closed positions that I post for the Fusion subscribers at RadioActive Trading. Yes, I'm going to bring up Icon again. Where is she? There she is. Here's the Iconics brand trade from 2015. 6 months in, stock was down 66% while I was in the position, and we made a profit of 4%. To be honest with you, that should have been 25% return with the stock down 66%. Why? Well, I got into the position when the stock was at $36. The first time I rolled down the put was, I opened it, I'm sorry, on February 13th, right? Yeah, February 13th. 1 month later, March 19th, the stock was trading at $33.95 from 36. Not bad, but that's that first 5% move. I rolled down the put to increase the risk. Okay, now, hindsight 2020, I probably should have bought the extra put here, but I didn't see the pattern yet. I thought it was going to recover. 4 months later, but I really should have done this beforehand. April 20th is when I should have done it. The CEO resigned, and it dropped down 16% immediately. I could have closed the position at that point and taken the loss because it was negative. But that's when I just should have bought the first income method number 12. I waited until later. Okay, so I bought on July 28th, I bought the extra put, a 20 put, for 85 cents with earnings coming up. And the stock's at 21.70 at this point. So what happened? After earnings, the stock fell to 14.45. Sold that put for $5.50, closed out my stock at $35, made the profit. What I'm saying is that in April 20th is when I should have bought, when the stock was at 26.77, I should have bought the 25 put at that time. Then it would have cost more. It would have cost about $2, but it would have been worth $11 at this point. So close that for 11, still closed the stock for 35, would have had closer to a 22% profit with the stock being down 66. But I was in a stock for 6 months. It fell 66% from my purchase price. I got out with 4%. Didn't play it right, but I can't call that a loser trade at all. Even though I only made 4% in 6 months, I can't call that a losing trade because I was in the stock the entire time and it was down 66%. Okay? So I managed it once with that income method number 9, you know, of in the blueprint to lower that lowered the lower level there, and then I'd go ahead and make an adjustment eventually where I did income method number 12 to profit in both directions. It was more of a bearish play, a protective play. I could have sold the stock at 26 and held the put too. I could have done that, and then that 35 put would have still increased, but I got 26 back for the stock, and then sold the other profit from 26 down to $14, $12 worth for the put increase from the time I sold the stock. I know, a little bit confusing, but I would never hold a stock if I haven't already tried to play the downside that's down 50%. If I'm in a radioactive trade, a stock and put position, when it falls that first 5 or 7%, I look to go ahead and roll the position down in price with income method number 9. Or a combination of 9 and 3, which I almost did with applied materials yesterday, and it would have been over trading. I meant to post a blog today. Ernie was going to give me some feedback on it, and I didn't hear from him, so I'm going to post that this weekend for radioactive trading there. But the newest position I opened on AMAT, let me go to the open trades, was on Monday, I believe. Yeah, there we go. Tuesday, 10/24. For applied materials, bought the stock at 56.27 and bought the April 57.5 for 5.40. Of course, what happened Wednesday, the stock was down to $53, $53.80. You know, it dropped with everything else on Wednesday. So I almost considered doing income method number 9 there and selling a 55 call because it had dropped. Well, I'm glad I didn't, because the stock's right back to where it was when I bought the position. It would have cost me almost $2 to buy to close the call. I would have gotten $1 for. Okay, so that's where I look on those positions. So if you reread that income method number 9 position there in your blueprint, that will talk about rolling the put down if the stock falls. Okay, but you don't want to really do it 2 or 3 or 4 times unless you really think the stock's going to recover. You only do that adjustment if you think the stock's going to recover. If you think it's going to go down, get out of the position for the small loss of 1 or 2%. Maybe sell to close the stock, leave the put open, and as Sam said, you might want to put a stop on the put after you do that so that doesn't get away from you if the stock does recover, or consider income method number 12 as I did on Icon, and even though the stock was down 66%, I'm still holding that extra put in place as well. Okay? All right. Sam mentioned, yeah, he overtraded Apple today, but was in a positive mode. I know, it's difficult. You were doing the laddering, I think, on your Apple positions there, those calls that you had emailed me about, and the Netflix trade for next week too. But it's, with these moves, the move we saw on Wednesday and the move we even saw today, it's so hard not to overtrade from over-panic. I have customers that rolled down, as we were talking about earlier, not the calendar spreads, but they rolled down the covered call. You know, they had a covered call open expiring this week. On Wednesday it dropped down. They rolled the call down, and then today it went back up. They're going to get assigned on those positions, or they have to pay more money to roll it out to next week. Had they just left it alone, they would have left it alone. It would have been in a much better position. It's really hard, especially if you have weekly credit spreads, weekly covered calls, weekly naked puts, and you get a Wednesday like we had just in the morning, and then it kind of settled down, so hopefully not too many over-panic trades there. But then today it just spikes right back up. So anything you adjusted for protection or for increased insurance might have snapped back on you in this case, and that's kind of the difficult row there to swallow. Difficult pill to swallow, I should say. All right, well, ladies and gentlemen, that does look like all the questions that we had coming in. I don't see any others. I just want to remind everyone, for those of you who haven't done so yet, just remember, if you go to poweropt.com, just put in your name and email address, and you can get a free 14-day free trial. You have use of the tools we showed today, including the patented search tool in all the strategies and the search by symbol tool that we didn't look at today, and the portfolio tool for tracking and managing positions. You'll have that all available to you for 14 full days with no credit card information or billing information required. And of course, after that, we have the different subscription levels. 20-minute delayed service is only $60 per month. And I mentioned the historical data, which goes back to April of 2006 to run historical searches in the search tool, as well as look at the historical chains and more. And of course, we do also offer a real-time service as well for those. Oh, sorry, folks. One last thing, if you want to check out some of our free information, check out the blog.poweropt.com or blog.radioactivetrading.com for more information on those limited risk married put plays and the different income methods. I gave you the link to the webinars page, poweropt.com/webinars.asp. Don't have to be a member. You can access that at any time. You can also check us out on our YouTube channel. Today's presentation was recorded and it will be posted this weekend. You'll be able to access that on the webinars page under the requested topics tab and also on the public YouTube channel. Now, if you think of any other questions later on, remember, send me an email at any time to support@poweropt.com. You can also reach us at support@radioactivetrading.com. You can also call us during market hours. I mentioned that those of you who are on a trial or subscription, you can schedule the free coaching sessions at any time. But you can also call the office anytime during market hours at 302-992-7971 as well. And of course, trial members and subscribers schedule that coaching session. Well, Sam, I hope, thank you everyone for coming. Sam says, thank you so much for the very kind and fruitful session. And hope you all have a good, relaxing weekend. Sam, we hope you have a good, relaxing weekend as well. Take some time off and come back strong on Monday. We're going to have a series of other live webinars next week on Tuesday, Wednesday, and possibly Thursday. Very likely Tuesday and Thursday, possibly Wednesday, I should say. And, of course, we'll be back next Friday, November 3rd, to talk about how some of these maybe calendar spreads worked out on Facebook there and what earnings had in store for us and where we are next week as well. So we'll be back once more next Friday at 4:30 p.m. Eastern Time. Take care, everyone. Thank you for bringing me your questions. Thank you for the candid conversation. Have a great weekend and a fantastic trading week next week if I don't see you. Hopefully we'll talk soon. Good night.